In the world of mortgage financing, sometimes you need a product that's a little outside of the box. For example, if you're on a 1099 job as a contracted employee, but you don't have 2 years of history, even though you might be making decent income. Or if you're looking to purchase an investment property that cash flows on paper, but you don't quite have the debt to income ratio in order to qualify with a standard conventional loan. Or what if you're looking to purchase a rural property on acreage that just doesn't fit inside the box that is needed. These scenarios, as well as others, are reasons that you might want to utilize a non-qualified mortgage. Now, non-QM might be a bit daunting at first, or you might correlate that to subprime lending or predatory lending, and that's just not the case. Oftentimes with non-QM products, it's going to be highly qualified individuals, but again, they just don't fit inside that box. The world of non-QM is what we're exploring in today's podcast with Stan Spencer from Change Wholesale. We cover financing options for the scenarios I mentioned earlier, as well as others. And if I haven't met you yet, my name is Connor Webb. I'm a mortgage broker, mortgage advisor, and it's my job to assist my clients in finding the ideal mortgage financing option for their needs. If you'd like to reach out and get in touch, I'll have a link in the description of this video. You can complete a form and I'll reach out to get in touch. Make sure to like and subscribe to the YouTube channel for more content like this, and let's get into it. All right, Stan, thank you for joining me on the podcast. I'm excited for this episode to talk through really all non-QM products. Let's start right there. What is non-QM and what case use would apply under that umbrella?
Yeah, so I think this is a great place to start. Yeah, first of all, thank you for having me on here, Connor. I'm excited to be here. So starting with what is non-QM, I think a good place to start is, what is QM, right? So non-QM is almost a process of elimination. So QM would be a qualified mortgage. It would be something that anything that's government backed, right? Fannie Mae, Freddie Mac, USDA, FHA, VA, those would be typically your non-QM mortgages. Generally speaking, those are going to be mortgages that you're going to get it. A loan officer will take a borrower's application, put them into an automated underwriting system, and it'll spit out conditions. And either if you can meet the conditions, you've got a loan. If you can't meet them, you don't, right? So it's pretty simple. It's pretty black and white. Non-QM is for any borrowers that are outside that space. It just can't qualify. We're not quite as black and white. It is a manual underwrite. So actually a human being is underwriting the file. It's mainly geared people. I want to take another step back. So people start to think that it's subprime. It is definitely not subprime. It is for self-employed borrowers. It's for investors. It's usually high net worth individuals who just don't qualify for a qualified mortgage. So, maybe it's someone who just has a great CPA. So they've got someone who write off a ton of money, ton on their taxes, and they just don't qualify based on their tax returns. Maybe it's someone who doesn't have a whole lot of money coming in that's documentable, but they've got a lot of rental properties and they can qualify based on the cash flow of the property. There can be a whole lot of reasons and a whole lot of people that we can do loans for. And some of them are really, really qualified, good, solid loans. Most of them are qualified, good, solid loans. There'd be people that you and I would loan our money to, right? So as opposed to some FHA loans where you look at it and go, man, these guys fit in the box, but boy, I wouldn't loan them my money, right? So it usually is. Our average credit score is about 740. Average loan to value is about 80% or less. I think it's about 75% actually. So good, solid equity positions, good, solid borrowers. They're good loans. They're just have alternative documentation.
And then kind of breaking away from that, you already described one of the scenarios to where the rental property kind of cash flows and, they're well qualified. It's just that they might not fit in the 50% debt to income ratio, so they're trying to find a way to qualify outside of the norm. So let's start with kind of what I just described, which is the DSCR loan. This is something that was brought to my attention and specifically for investor types. I have some investor clients that are looking to, add more properties to their portfolio. But like I mentioned, maybe the DTI isn't quite there. So what is a DSCR loan and what is the case use for that?
Yeah, so the DSCR stands for debt service coverage ratio. So what we're doing, this is a no income, no employment, non-owner occupied loan, non-occupied program. So we're just looking at the borrower's credit, their equity or LTV position, their reserves, and the DSCR ratio. And the DSCR ratio is the rent divided by the full mortgage payment. Or in the case of Change Wholesale, the company I work for, it could be better stated as the rent, the appraiser's opinion of rent, or the AirDNA rentalizer estimate of short-term rentals divided by the mortgage payment. So any one of those. So in with that, what we're really determining there is whether or not the property cash flows,
Mhm.
right? So with the rent divided by the full mortgage payment, if that ratio equals 1 or above, that means in underwriting's eyes, the property cash flows. If that ratio is below 1, that means the property has a negative cash flow. There are loans for both out there, but it's a much better loan for the borrower if we can get that ratio at 1 or above. So this is an easy way for an investor to qualify. They're just qualifying off the cash flow of the subject property. We're not doing a debt to income ratio. We're not evaluating any of their other properties. So we're just looking at, again, to get their credit score, their equity or LTV position, their reserves, and that DSCR ratio. Reserves are pretty low. I think on our program, it's about 3 months. Most people's it's about 6 months. Minimum credit score on it is 660, so you can get pretty aggressive for credit. And maximum LTV is about 80%. That's with a 720 score, I believe.
Okay. And yeah, as you mentioned, it's like you're not even looking at the additional properties that they might already own. It's just that
Mhm.
current property that they're trying to get financing on. So for the amount of rent, is that you might have already described it a little bit. Is that based off of a rent schedule that would be ordered? Is that on the current lease agreement? What is that based on?
So for our programs, if it's a purchase and the property is vacant, or the our borrower gives the current tenant a notice to vacate, we can actually use the AirDNA estimate of short-term rentals in that calculation, which is a really aggressive way to determine that DSCR ratio. So most lenders require that they use either the lesser of the current rents received or the appraiser's opinion of rent. Whereas we can use that DSCR, we can use that AirDNA rentalizer in that calculation. So that's on a purchase. If it is a refinance, we can use the current rent amount over the appraiser's opinion of rent, as long as we have 3 months proof of receipt. So and there's no limit on the amount that it can be above the appraiser's opinion of rent. We can also use short-term rental income. So if it's like a Airbnb or a Verbo type property, if we have 12 months proof of receipt, we can use that in the calculation as well. So there's a lot of different ways that you can determine, which rent estimate we're going to use, or which rent amount we're going to use.
Yeah, that's awesome. And as it describes on here, large deposits do not need to be sourced. You can use this for
Mhm.
a purchase or a refinance, either scenario. Yeah, DSCR is definitely a program to look at if you're looking to gain investment properties and get them into your portfolio.
Yeah, great program for investors for sure.
So let's go into some other programs that you might have. Let's start with one. Let's say there's a realtor who just got into the business, a year ago. Typically, the guidelines say that you need 2 years of tax returns if you're self-employed in order to average those out and get you qualified. What type of programs might you have for business owners that might be newer to where they have an excess of cash flow, but they just
Mhm.
don't have seasoning to be able to qualify under the standard umbrella?
Right. So yeah, under the standard umbrella, you're looking at a 2-year job history to qualify for a qualified mortgage. For us, so I have several different programs. My most aggressive is our Express program, and we have a minimum of 12 months seasoning on self-employment or 1099 work, whatever the case may be. We can go up to 85% loan to value, so the borrower will have to put 15% down. That's really aggressive relative to the market. There are other lenders out there that will do less than 2 years, but it's usually an exception for them. Whereas we can go as low as 12 months, and it's in the guidelines. It's not an exception. So that's a great way to get somebody who is recently self-employed, or recently 1099, a recent realtor, into a home, or provide a refinance option for them. Um, for 1099 employees, which is pretty cool. So most underwriting guidelines require that the borrower provides their tax returns if they're 1099. So most realtors are 1099, right? So with our 1099 program, we only take a 10% expense factor. So we're going to take their 1099 income. We're going to take a 10% expense factor, easy for me to say, give them credit for 90% of their 1099 income. We do not need tax returns, and we can just move forward with that. So really aggressive, great program for real estate agents. And we can also, if that doesn't work, we also allow personal bank statements. So we can put them into a bank statement loan, which we're going to take 12 months of their personal bank statements. We're going to add up the deposits, divide it by 12, no expense factor on personal deposits. They don't have to be self-employed with us. That's another niche that we have. Most lenders require that the borrower is self-employed to use bank statements. So for a realtor, if we don't want to use that 10% expense factor, put them into a bank statement loan, they can get credit for 100% of the deposits, and we can move forward with that as well. So some really aggressive and different options for realtors.
Yeah, and to those of you that are listening, this is huge because typically in the typical scenario, we take the gross amount. You typically have your write-offs, And with business owners, you typically try to write off quite a bit just to
Mhm.
reduce your taxable income.
Right.
And for standard qualifying, we go off of the net income number for the last 2 years to help you qualify. So in this case, it's not the net, it's your gross income. And as you mentioned, the 10% expense factor. So that brings a lot of people into potential qualifying, whereas they wouldn't be able to qualify otherwise.
Right. Yeah. It brings a lot of people that there's people that slip through the cracks with qualified mortgages, people that are very qualified, that make plenty of money, that just for one reason or another aren't able to fit into that tight little box that that you have on an agency type loan.
This is kind of an out of the box question, but it's rather common. Let's say someone's going through a divorce. The standard financing, we have to wait until that divorce is finalized. Do you have any programs that would allow it so that they can close before a divorce is finalized?
I think if we have a signed or a court ordered separation agreement, recorded separation agreement, we can move forward with that as well. So they don't have to be completely divorced. One program that we have for that we haven't mentioned yet is our community program. And that is this can be really good for somebody who's recently divorced and is taking over the property. So this is a no income, no employment owner occupied program.
Okay.
It's one of the only ones in the market that has this program. We have an exception on the ATR requirement. That's the ability to repay requirement that every other lender in the country except one and us is required to follow. So if we have maybe a homemaker that was recently divorced and is taking over the home and needs a loan, but they haven't had a job, this is a program for them. So we would leave the income and the employment blank on the 1003. We can go up to 75% LTV on a rate and term refinance and move forward. So we're not going to do a debt to income ratio at all. Minimum score is 680 on that program. And reserves is going to be between 6 and 9 months, depending on the LTV. So if they're at 70% LTV or below at 6 months PITIA on the subject property owner, that's principal, interest, taxes, insurance, and any applicable association dues. If anybody, sometimes I geek out on these abbreviations. And on a cash out refinance, we can go up to 70% LTV. So that's a great program for them as well.
And I'm looking at it right here. This is interesting also. Debt consolidation is not considered a cash out. So in the
Mhm.
typical situation, if you're looking to pay off, combine high credit card debts and pay those off, that would be a cash out refinance. So in this case, it would not be considered a cash out. It would be a rate and term.
Yeah, so that's a really aggressive feature on that program. So as long as they're only taking $2,000 or less cash in hand and all they're paying off is consumer debt with the proceeds, it will be considered rate and term. You can go up to 75% LTV and use rate and term pricing. So
Wow.
that's really cool.
And then also adding to that, the cash out can be used as reserves. Whereas typically, if you're pulling cash out or paying off debts and all that stuff, then that can't typically be used as reserves.
Right. Yep. So and on that feature, that's up to 60% LTV. Cash out can be used as reserves. If you go above 60%, then we expect the borrower to prove their reserves. But the cool thing is we also only use 30 days seasoning. So most lenders are at 60 days seasoning. So they just need to provide one bank statement. I believe it's within 120 days of the note. So a lot of flexibility there on that too.
And then going down the list here, can you go through the written VOE only and what that looks like?
So we're going to move forward using just a written verification of employment and use that for the income. We don't need any bank statements or anything or any kind of proof of receipt of income. And that's a really aggressive program that we can use as well. We've got some other ones too. We've got a P&L program where we can do a profit and loss statement that is provided by a CPA, a licensed tax preparer, an EA, which is an IRS enrolled agent or a CTEC. And we also don't require any proof of receipt of the income on that as well. So they don't need to provide bank statements or any kind of year-to-date income. So a lot of aggressive ways for self-employed borrowers or for to use or different ways to calculate income. We also have a W-2 only program. So if somebody were to just provide us their W-2, let's say they had a great year in 2023, but 2024 hasn't been that great, right? And they just provide us 1 year's W-2, we can use that. We don't need a year-to-date pay stub or anything to determine their current income. We're going to do a verbal verification of employment to make sure that they're still employed by the company, but we're going to calculate their income off of 2023's W-2 on box 5 on the W-2.
Well, that's also really big because yeah, if there's more than a 20% decline year over year, it's like that's a red flag. We can't use that
Mhm.
income. It's declining versus
Right.
this. you could kind of bypass that. And then getting into standalone seconds. So there's the standard HELOC, home equity line of credit.
Mhm.
Do you also have HELoans, and what other types of standalone seconds might be available?
Yeah, so standalone seconds have become a lot bigger deal in the most recent, most recently because a lot of lenders, a lot of borrowers are sitting on a 2.75 to 3.5 mortgage, and they're not going to move that mortgage, but would like to access some equity in their home. We've seen strong market depreciation or appreciation, excuse me, and so this is for us. Our standalone seconds are going to be closed in, so they're not. It's not a HELOC. I think our minimum loan amount is 50,000. Our maximum loan amount is, I think actually our minimum loan is 100,000. Our maximum loan amount is 500,000. But the cool part is we can use all the alternative documentation to get a standalone second for them. So we can do a bank statement loan, a 1099 loan, a W-2 only loan, different ways that we can calculate income and still get them that second mortgage. So for those people that just kind of fall outside the box, again, we can get them a standalone second.
Yeah, those are great options, especially as you mentioned, people are sitting on super low interest rates. They don't want to move. They don't want to do a cash out refinance. So
Mhm.
getting a HELOC or a second loan, standalone would be a great option there. And then
Mhm.
what type of options do you have for rural properties?
Yeah, so rural is up to 20 acres. So first of all, most non-QM lenders do not do any rural. We can do rural up to 20 acres. We can do owner-occupied and second home, so we don't do investment rural. And it's going to be up to 75% LTV, and it's purchase and rate and term only. We don't do cash out on rural, but it's a great option, for again for those borrowers that are outside the box and need a loan on a property on 20 acres, up to 20 acres. It has to be a single-family home on acreage, right? So it can't be a ranch or an orchard or a farm or anything like that. It needs to be a single family home, but that's another great option that most lenders don't allow as well. We also have a strong advantage with properties that maybe are in a smaller town, that other lenders would consider as rural. So properties that the determination that most lenders use to determine if a property is rural is if one of the following three things is true. So if the appraiser marks the property as rural in the appraisal report, the lender will consider it rural. If the appraiser marks on the box in the neighborhood section that says that the neighborhood is less than 25% built up, the lender will consider that rural. Or if 2 out of the 3 comps are more than 5 miles from the subject, then the lender will consider it rural. For us, all 3 have to be true, or we don't consider it as rural, and we can just use regular guidelines, which is pretty cool.
Yeah, that allows for definitely more options. And then, so that doesn't mean land loans. So there would have to be a property on the piece of land.
Right, yeah, it needs to be improved with a home, a single family residence. We don't do manufactureds either, so but it could be modular. We do modulars as well.
Okay, awesome. Yeah, I mean, ton of products that are available. Really, anything that's not in that box, I will be sending to you guys, and that's what I love being on the broker side now. Is when I was at retail, it's like if it didn't fit inside this box, it was too much of a pain. So it's like, all right, we just can't do it. Now
Mhm.
it's like, we have access to all these different lenders, including yourself, to where it makes it seamless being able to partner up and offer all these different products that just we didn't take the time or we didn't have available at other places.
Right. Yeah. The mindset used to be if it didn't qualify for a qualified mortgage, it didn't qualify. Right. So,
Yeah.
so those loans kind of fell through the cracks. But the financing options have been really limited since 2008. When the crash of 2008, the wholesale market kind of dried up, and there were most loan officers became retail loan officers, and they had access to their in-house products, and that's it. And most of their in-house products were just qualified mortgages. We've seen a serious resurgence of programs again for self-employed borrowers, for investors, and that market is really opening up. I think in 2022, about 15% of all loan officers had done any non-QM loans at all. Since that time now, it's about 30%. But what that means is there's still a lot of runway out there. There's still a lot of opportunity in this space, and I think a lot of real estate agents don't know about these programs. They don't realize that there could be a buyer that they thought was a dead deal that could be brought back to life. So a lot of cool options, a lot of opportunity to get additional borrowers financed. And it's, when we take a look at who can afford properties these days, and we've seen such huge appreciation with where rates are. Typically, when we get into the upper end, into the jumbo and super jumbo market, it tends to be the self-employed borrower, it tends to be the business owner, and those borrowers tend to be a little less rate sensitive. And speaking of rates too, that's probably a question that I think our listeners would probably want to know a little bit about too. What are the rate differences? So the difference between our loans and what you'd find on an agency loan, at 80% LTV, which is what we see for most of our borrowers, we're about a point higher. So about a point higher to rate, which isn't, considering what we're doing and considering that it's not government backed and that these are private investors, it's really not that extreme. It's not like it's private money at 12%. So if you've got a Fannie loan that's in 6.5, we're going to be at like around 7.5. So and most self-employed borrowers don't care so much about the rate. I mean, obviously we're all a little bit rate sensitive, but they're going to be less rate sensitive than the typical agency borrower because they just haven't had the financing options available. And an example I would give would be, maybe you've got a self-employed borrower who makes a lot of money, right? So they make $1 million a year. They've just got a really good CPA, and so they're, with all their write-offs, they're only paying taxes on like 60 grand. And this borrower wants to get a $3 million loan, right? Because they only have 60 grand on their tax returns, when the real estate agent sent them to the loan officer looked at their tax returns and said, hey, you qualify for a $300,000 loan. And the borrower didn't want to come up with 2.7 million out of pocket, right? Either they didn't have it or don't want to put it in the transaction, which either one would be very likely, right? So most business owners are pretty savvy. They understand leverage. They understand that 2.7 million could be better served in their business, or investing in crypto or some tech stock or who knows what. Now, this bank statement loans are different ways of providing financing options for that borrower, can bridge the gap of that 2.7 million. We can get them that $3 million loan. And, the rate's a little bit higher. It's a point higher, but most business owners aren't going to be concerned about that. They're going to be more thankful if they get to keep the 2.7 million in their pocket.
Right. That's not bad at all. Especially, I mean, that's not even close to where HELOCs are even at right now.
Right.
So, yeah, tons of options. It really opens up the spectrum of what we can do and what we can offer. So really appreciate your time to come on and explain a breakdown of some of the programs. If you have any questions, make sure to reach out to us and we'd be happy to assist you on your next financing.
Awesome. Thank you, Connor.